Compound interest is the eighth wonder of the world, right? Well, that's what Einstein said. But before compound interest takes effect in your investment portfolio, you actually do need to start investing, because I can guarantee you that it won't come out of nowhere with your money just sitting there doing nothing. So stick around and we'll go over the 7 things you need to do before you start investing. What's up people, welcome back to my channel. We're talking all things investing and personal finance. If you're new here, my name is Robert. Welcome to Power Finance. If you do enjoy today's video, make sure you leave a like on it. Consider subscribing. Let's dive into today's video. I'm sure all of us can agree that investing can be exciting. If not all of us, then certainly the majority of us can definitely agree to that. You know, through the market surging to all-time highs, the market's crashing, it can be frightening, but definitely exciting at the same time. So you just can't throw your money into the markets hoping for the best without actually knowing what you're doing. So number 1 on the list of 7 things you need to do before investing is to consider setting up an emergency fund. An emergency fund is money saved aside for emergencies. And you never know, these could be personal emergencies, medical emergencies, or even your typical car breakdowns, who knows. So in your time of need, you can use that money to pay for those unforeseen expenses. You know, you can never expect them to pop up, but they just pop out of nowhere. So you just have to stay prepared for them. The money in an emergency fund should be liquid. Not liquid as in water, but liquid as in the fact that you should be able to gain quick access to that money without any problems. You know, you can't just tie your money up into non-liquid assets which could take you a long time to sell. And if emergencies do pop up, then you're screwed because you don't have any funds to help you at the time. So even though that money is just sitting on the side there, not making any money, you should not be tempted to just tie it up into assets that you can't sell like that. To get started, there are some people that claim that you need to have maybe 1 to 2 months of your monthly expenses in your emergency fund as a way to lift it off the ground and get it started. But there are some sources that claim that you need to have maybe 6 to 9 months of your monthly expenses in your emergency fund. But 1 to 2 months is a great start. If you have 6 to 9, well done to you. That's a perfect place to be in. But the worst thing you can do is go into debt to pay for your emergencies, which leads me into number 2 on today's list of 7 things you need to do before investing, which is pay off your debt. Now, don't get me wrong, this is not me saying that you need to pay off every single debt that you have before going into investing. I'm just specifically focusing on those high interest rate debts, because those interest rates, they work greatly against you. So it's only right to cut them out of the picture once and for all. Let's say you started investing. Great. You invested in maybe, let's say, the S&P 500, which is racking you maybe 7% annually, give or take, which is fantastic. That's a great percentage to get a return on investment of. But then at the back of your mind, you know that you have 9% interest rates racking up on your debt year on year, and there's nothing you're doing about it. That's not a position you want to find yourself in. So you can see that if you make 7% of the S&P 500, your interest rate debts 9% every year racking up. You can see that comparing the two, you still have a 2% difference that you're losing to your debts, and those debts are still racking up. That's not a position you want to be in. So you need to cut out those debts, just get them over and done with, so you can enjoy that 7% you could have been making instead of just waiting for it to be wiped out on those debt interest rates. The only way you can come out on top is if those investments are making a much higher percentage than those interest rate debts are racking you. But no one's quite sure about their investments. No one knows if they're 100% going to get their money back or make their money, lose their money. You never know. It's the markets. They crash, they surge. You never know what could happen. So it would just be better to cut out those interest rates that are working against you. Hell, if everyone knew that they were going to make their money back, I would just invest everything. You know, everything I own, invest everything, sit back, let the money come to me. But no one knows, so you just have to play it safe, get your debts down, and then move on. Number 3 on today's list is to know your risk tolerance. Now here's why risk tolerance is quite important. It's just the size of a loss someone is willing to take in their investment portfolio. You know, younger people have a longer investing horizon, older people have a shorter investing horizon, and in general, the longer the time period someone has to invest, the greater the risk they can take on. A person with a high risk tolerance will be willing to risk more money in the markets Whereas a more conservative investor will be looking to lower the amount of capital they put into the markets, therefore lowering the amount of risk they can take. To work out your risk profile, you need to consider things like your investment goals, your fear factor, and the amount of time you have to invest. Hence why the earlier you start, the better it is in general. Number 4 on the list is to get educated about investing before you actually get into it, because you don't want to get in there and then not know what you're doing, just chucking your money out there hoping for the best. So you rather just get educated, know what you're doing, judge your investment decisions. As Warren Buffett once said, never invest in a business that you cannot understand. So if you don't learn, how would you understand? The least you can do is at least try to understand the business you're trying to invest in. You know, you can't just go in blindsided because someone else has told you to invest in it or you saw someone else do it. You know, not understanding your investments will be like you getting chucked into the cockpit of a jumbo jet without knowing absolutely anything about flying aeroplanes. It's just going to be a disaster. Understand the risks of investing before getting into it, because investing doesn't guarantee you any returns whatsoever. There's no promises on it. So you need to just educate yourself. At least you understand what you're getting yourself into. Why am I making it sound like it's joining a cult or something? Anyway, you'll feel more confident about your investment decisions and not have to worry if you've lost your money or not. So to get started with the education process, it's not really a hard process. You just have to go online. There are some free resources. You can invest in some books, invest in some mentors. There's ebooks, there's online courses. There's tons of resources that you can tap into to get started. So why not just make the process easier for you and just invest in those? Number 5 on the list is to master your emotions. Being emotional in the markets will leave you mentally drained. So you need to prepare yourself, have your emotions in check before you enter the markets. You know, this one's a crucial one because investors get all caught up when their investments are going up, they're in profit, they're all excited. But when they're going down, they see the red, they just start getting emotional, get caught up in their emotions, which may lead them to sell out of their positions. Let's just quickly think about the term buy low and sell high. I'm pretty sure most of us are familiar with that term. So it doesn't make sense to sell out on your investments when in the red days of the markets. And this is where your emotions are tested. You know, in the red days of the markets, you want to just hold on to your investments and not sell out on them. Just wait for them to bounce back up. But for the emotional people, they'll just start like selling out their positions and just cashing out, done and dusted with it. So if you have that emotional strength, you just keep yourself together, hold your investment through the rough days, and you will see the news, negative headlines, but the market will still fluctuate up and down whether you like it or not. Coming in at number 6, you need to understand the type of investor you are. There are different types of stock market investors. You need to understand the type of investor you are, because this will be way easier than going in blind and just chasing for every investment opportunity there is out there. Just need to understand what investments suit your investing goals or what investments suit your risk tolerance and so on. Types of stock market investors include active and passive investors. You know, active investor has a lot of time in their hands. They like to manage their positions short term. They keep up with the financial news and just in general do a lot of research about the positions that they get into. So just know the type of investor you are. You know, it could save you from being too greedy whenever you see an investment opportunity, because you can't capture every single opportunity that comes your way, right? You just have to know which ones suit your investment goals and just go about your business. And finally, number 7 of the 7 things you need to do before investing is to actually get started. The biggest mistake you can do is waiting too long to start. You cannot be timing the markets. You know, the longer you wait, the higher the prices go up, the more you miss out on. If we just have a look at this chart of the S&P 500 crashing in the beginning of 2020, and let's say you were trying to aim for the very bottom of the crash, and the target price you wanted to get in at was at the $2,000 mark. So you see it crashing and you're just there thinking that yes, it will hit your $2,000 price target. But before you even know it, it doesn't even hit your $2,000 price target and rebounds up to the upside to the $4,000 mark. Now what happens? well, you've missed the move and you're in deep regret now, leaving you like,
I should have got in while it was going down.
Look how much money I would have made.
it's almost similar to the people that missed out on Bitcoin when it was at $7,000. However, as the S&P 500 was crashing and you're buying into it little by little, you'll be dollar cost averaging into the markets, giving you a lower buy price overall. Although you haven't caught the very bottom of the market, but at least you managed to enter in at a discounted price. And hey, who doesn't love a discount, right? And of course, it is well known that time in the markets beats time in the market. If you understand how the markets work, you will turn out to enjoy the process and not stress too much about it. Hopefully I've given you some points to think about before you start investing. And if you've already started investing, let me know in the comments below if you've done any of these steps before you started your investing journey. If you did enjoy today's video, make sure you leave a like on it, hit that subscribe button and turn on the notification bell, because I hit you with content like this every single week. Until next time, peace.